Hi, Peter. Welcome to VC Talk. It's my great pleasure having you. How are you?
Thanks, Max. Thank you. I'm very well. Thank you very much.
Thank you for coming. So, just a very short intro. VC Talk is talking with investors, not only VC, but angels and even entrepreneurs who had at least invested a few times in startup. Not your case because you've done more than 100 investments. And sharing knowledge with startup and letting them understanding better how the VC world works, because many times they have no idea, and this maybe that's my hope, connect them to better understanding your way of thinking. So let me start asking yourself to give a short intro.
Yes, hello. Thank you very much. So thank you, Max. I'm very pleased to be on the show. So my background is I was born in the north of England, moved south to the university the town I live in at the moment, which is Cambridge, and then started in a bit of corporate life in a software house, moved to Bavaria and spent 5 years there. And I set my first tech startup there in 1981. Since then, I've founded or co-founded 14 businesses. And then various other things. I was also involved in charities. So I've been on the board of seven charities. So I know quite a lot about social entrepreneurship, etc. And then I moved back to Cambridge about 20 years ago, and I stumbled into angel investing. And I've actually invested in slightly less than you just said. I've invested in 76 companies, but I've also co-founded 14. So I've been on, or am on, 90 journeys. Of those 90 journeys, about 40 have gone by the wayside. So there's about 50 or so left invested in, or my own two businesses I have myself. Very briefly, some years ago, I was noticed as being an angel investor, basically. I became Angel of the Year here in the UK, which led me on to other roles. I've been on the trade body of the angels here in the UK, UKBAA. I was president of EBAN, which is the European Business Angel Network. And I'm now on the board of the Global Business Angel Network. So I've helped the ecosystems, one could say, throughout the world. On top of that, I do a lot of public speaking, and I've written a couple of books, The Investor and Founder, which you can see.
I love your book.
I've invested in, I've deal led many times. I've been on 40 boards of various sorts. And so I have my own strong opinions, hopefully weakly held. So I have an opinion and experience of all the things that we're going to talk about. So thank you, Max. Back to you.
Thank you, Peter. Thank you very much. So let me start talking with my first topic, right? I share with you. In which area do you prefer, and also geography, to invest?
Yeah, so I'm very open, probably more transparent with what I've done and the teaching than any other angel, certainly in the UK. So I have a website, petercowley.org. On there are my investment criteria. Now, I should say I'm now 66 years old and I've stopped investing except in my current portfolio a couple of years ago. But based on those criteria, I developed geographically, which is crazy. It sounds like what they do in Silicon Valley. Anything that's no more than 90 minutes by public transport. The reason for public transport is that if you're driving, you can't do much. You can have phone calls, but you can't do emails or anything. And 90 minutes by public transport does not get me to the north of England, although I'd love to invest in the area I came from. And it doesn't get me to Paris or to Milan or whatever. It's relatively local. Now, COVID has changed that for many angels because of Zoom meetings, etc. But the two reasons it's that distance, one is that pre-investment, it means I can visit the entrepreneurs where they are. And that's the reason for that is because I do more hardware than many other angels. I like to see laboratories, whether they're biotech laboratories or battery technology laboratories. And secondly, I can assist more in the future if I can go and visit them. To the other part of your question, what sectors? Like most active angels, I invest in things I understand. When I invest in people with a plan, not plan with people. That's a really important. We'll come back to that later. But the plan is usually involving tech scales, and I like to understand what that tech is. And my background is software and hardware, sensing technology, software, etc. It's not really life sciences.
Thank you. In terms of investments, how much is invested in the companies?
Yeah, I've been asked this many times, and I've answered the same way many times. The only people that know how much I invest are my partner and HMRC, the tax authorities. The reason I do this is that if one invests small amounts and has good exits, that's good enough. If you're worth 100 million, having a 5 million exit won't make much difference. If you're worth 500k, having a 10k exit will make quite a bigger difference. So although my ticket sizes are relatively small, if I get a good exit, it is life. Have you heard the phrase car changing, house changing, life changing? The amounts of money you can make. I've only had a couple of life changing amounts out of that. So I don't give that number. And in any way, actually, I think I can add more value with my background, my connections, my experience than I can with my pound notes.
Thank you. I mean, in UK, we have a very nice scheme, okay, when it comes to investing in early stage in venture capital. Enterprise scheme are pretty good. And I'm coming to tax. Now, when you invest, what's your which are the main concern you have about the company, the team, and the product? We all know that early stage is primarily about team. You said already. Which are the main concern you have? What do you think about when you need to understand the company, team, and of course the product?
Well, I think I just answered that a few moments ago. It's people with a plan, and it's not person with a plan. It's people with a plan. I don't know. You probably have been in the industry long enough to realise that a single founder will struggle to get investment. It's not impossible, but it's very difficult for a single founder. In the same way that 4 founders together will struggle to get investment. There's just too many people to cut the initial pie. And my experience over the last 15 years is that quite commonly 4 founders becomes 3 and possibly even 2. And that is a painful process. So in the end, it comes down to the people. However, they must have a plan. They must have something which is developing technology to the point where they can get to some sort of product market fit and therefore sales. Although, having said that, if you take my exits, there are quite a few of the exits I've had which really haven't had any sales at all. These are IP, they're not acqui-hires because they tend to be quite low, but they're IP plus team exits. So it's not essential to have got to product market fit before you get to an exit point. But yes, so it needs to be the team. And by team, this is a combination of both the individuals in the team and the team dynamics, how they work together, how they play off each other, how they challenge each other, etc. So it's not any, having a patent filed but not granted is useful, having an MVP is useful, but in the end it's the people that will build the business, not what they're doing at that moment.
I mean, you have a lot of experience. Based on experience, what should be in somehow the right number? I know there's not a right number, but maybe, as you say, 4, 5, and 1 are not exactly the right ones.
So the right number for me is 2 or 2/3, and of those people must have known each other quite a while. They must have worked together enough that they've seen some good and bad things, which is why I'm not very keen on talent-led accelerator programs where you pull together people that haven't necessarily got ideas, and you'll put these programs, and Entrepreneur First is the most famous here in the UK. They put together the people and then the idea, and then 13 weeks later they go out for investment. I want the people to have known each other for a while, whether they've known each other possibly even as long as school, at university. Working together is the best thing. So so I need them to have bonded and seen, and because it's really hard work building a startup. It's much harder than most people realize. You're smiling there. I've done it a few times.
It does.
And then secondly, of those 2, because I invest in technology, I don't invest in service businesses. Although, as it turned out, my biggest exit, my 107x, was a tech business that turned into a service business. I'd still invested. It was too late to divest. Of those 2, one should be fairly deeply or very deeply technical, and the other can be technical, but must also be commercial. Because the first thing that founders need to do, and it's usually the commercial person, the CEO, they need to sell something. And if they're going to, they need to sell, if we're going to have external investment, they need to sell equity. They must be able to sell equity. They must be able to get the money out of my pocket into their pockets, basically. After that, they need to sell the vision to early employees who have to take a big risk for moving from a bigger company into a smaller company, and then they'll move on to selling the product and maybe selling, they're even having to sell to suppliers. You want to supply of something, your hardware. It's really difficult to get a big company to sell to a small company. That still requires selling. So you heard the word hustling. Hustling sounds a bit American to me, but it's the ability to sell equity is the most important thing to start with.
You have been talking before proximity, okay? 1 hour, 1 hour and a half. Now, how often do you like to meet funders when investing in them?
That's if I'm leading a deal as deal lead. So this is the process where I'm bringing other investors in. Before I invest, I need to probably spend 6 to 10 hours with them. This is getting to know them, getting to know the dynamics between them, exploring the technology, probably mentoring them, talking. We'll be putting together a term sheet, which will set valuation, etc., negotiating that. If I'm not deal leading and I know somebody else who is, I probably don't need to spend very long with them, maybe no more than an hour, because I know the person who is leading the deal will be the person that's doing that sort of work. After the investment, the amount of time spent, depending is how far I am from the organization. So if I'm chair of the board, then I'll spend a lot of time with them, obviously. If I'm a non-exec director, I'll spend less. If I'm a board observer, which is a different role, I'll spend a bit less. If I'm an interested shareholder, a bit less. And if I'm a passive shareholder, which of course I am in some, I've got 48 live investments. I can't spend even an hour a week with all of them, then I might not spend any time at all. So it all depends. So as chair, I'd probably expect to spend an hour or 2 a week, perhaps even 3 at the beginning. And then as a passive investor, I'm spending 0 hours a week. So the question depends on how close I am to the company, how much value I can add.
Did you lead so far in investments, and what is required for you to lead an investment?
A big question. I'm giving a talk to a group of angels tomorrow morning, actually, on deal leading, amongst other things. It's a group down in Surrey. So I have led 30 investment rounds, of which 12 have been first rounds. The first round, by far the most difficult round to lead. I've also led 6 deals that have been to term sheet and failed. So the lawyers are already involved and they've failed. I've learned a lot from that process. We could spend the rest of the next half hour talking about deal leading, but it can be hard work, because on one side you are negotiating, discussing, mentoring, coaching the entrepreneurs. On the other side, you're selling the opportunity to angels. Not overselling, of course, but selling enough that can bring them in and get enough capital together. And that may not be just your own group of angels, it might be others as well, other groups. And then it's really difficult, because angels generally tend to be very busy people. And so I use the phrase herding feral cats. So this is trying to get herding a group of wild cats together. And this can be really tough. But I've got a whole chapter on the book in deal leading. So I suggest we either do it for another session or you read the book, which you have.
I think I did. I already did. It's a beautiful book, actually. I will advise everyone to read it. It's so well done. And for any beginner, it's absolutely, they must read it. Thank you. Now, did you we've been talking about the leading, and after you had a round and maybe the startup needs another round, and the second, the third. So do you get involved with following the rounds?
I do, and again, it depends on where I am in the onion rings between chair and passive investor. So if I'm on the board, and usually I'm on the board, well, it's always the case where the chair or just a director, I'll be the investor director. So I'll be representing other investors. And also I have my Rolodex, my connection list is very much bigger than most entrepreneurs. If they're on their second or third journey, that's different. But generally they're on their first journey. So yes, I get heavily involved in connecting VCs or other angel groups or other angels for that next round to a certain point, and then I become less relevant. So once it's raising 10 million or something, so this is A plus or a B minus round nowadays, then no, I don't have the connections there. And in fact, my skill set is startup rather than scale up. So generally, I'll come off the board once it gets to that funding size or a revenue of perhaps 3 or 4 million, because my time is better spent helping another business, and my own experience in business isn't that level of scaling up. So yes, it depends where you are. Even as an interested shareholder, so that's outside the board, I will get involved with that. I'll meet the entrepreneurs perhaps once every couple of months, and during investment, bringing new investment in, my skill set is particularly useful to them.
Thank you. I mean, you've been investing in many startups, and my question is, which is for me, it's extremely important actually. I always been thinking when I should invest, or maybe when I'm going to invest in a startup, should I think about how this startup can play inside my portfolio? Okay. So my question is, how do you play in this way? How does it work in your way? How your startup, if they help your portfolio, should they?
Yeah, that's a really interesting question, actually, because I've never really done that. So I've invested in opportunities. So these are founders with a plan. However, to some extent, even if before investment, I might make the connections there. But once I've invested, then I'm always open to opportunities to connect people. And, some of us are super connectors. I happen to be one of those here in Cambridge. So a lot of people come to me to be connected proactively. Reactively, and I also connect proactively. So if I can see an opportunity for that company to work with that company, or that CEO to learn from that CEO because they're 2 years ahead of the journey, which in fact is what the second book's all about. It's about founders usually talking to entrepreneurs who are 3-4 years behind them in terms of their journey. So yes, the whole portfolio post-investment, I work on and getting to work together. But I've never done what you've suggested, which is an interesting idea. The fact that I bring companies into my portfolio because they're additive to the whole portfolio. I just haven't done that.
Thank you. I mean, this, I know there is no investor who would like to talk about failing, but happens
Yeah.
quite often. So what happens if the startup you invested fails?
Yeah, well, obviously, if I'm a passive investor, I just have to get the bits of paper and claim my tax relief. And if I'm a very passive investor, if I'm getting a bit closer, or obviously on the board, it's a different matter altogether. If I'm on the board, I try to ensure that they will, because most companies, I don't know if you're aware, will fail because investors lose faith and they haven't got to break even. We might come to this later on. You really want them to fail solvently. So by failing solvently, I mean not leaving behind creditors. Now, they'll always leave behind the shareholders. We have to accept that our capital is gone. We get some generous tax reliefs in the UK for that, but our capital's gone. But you don't want to leave behind staff that have got pay in lieu of notice, or redundancy pay, or landlords that haven't been paid their rent, or the tax man not being paid. You want to close it down somehow so that there's very little money in the bank account. That's really difficult timing, and I've had this conversation many times. To close insolvently, which means you've got creditors, I think is a badge of dishonor. It's difficult to do, but it happens. I had lunch yesterday with an angel who's invested in more than I have, 85 companies. He's had 7 successes and 18 failures, which is about sort of right, 1 to 4, 1 to 3. I've been very lucky. On my website, you'll see my failures and why it failed. I've given expressed views about that. Usually product market fit has not been reached. I've had about the same number of failures and successes. In the end, the actual number doesn't matter. It's the amount of money you get out of the successes offsetting the failures. And again, my numbers are on my website. I've been lucky so far. But yeah, letting a company fail, and now I'm talking about the non-emotional part of this. The emotional part for the founders is huge. I've had a company that went insolvently bust. I've shut a few down at my startups, one that went insolvently bust. And the stress and the mental anguish that one goes through as a company fails is huge, absolutely huge. So supporting them through that process in such a way they don't lose their self-esteem completely, and they've got a plan post-failure, because suddenly they're also one of the unemployed, aren't they? They haven't got a role any longer. It's really, really painful.
Absolutely. Hide one has been extremely painful. Insolvency, it's a big nightmare when it comes to failure. Yeah. Now, why did you become an investor?
By mistake. I stumbled into investing. So what happened was I'd been entrepreneurial in both tech and some B2B and some B2C, and in property, again, B2B and B2C. And I came back to Cambridge, and I was set up a mentoring program, or coach, no, it was a mentoring program for the course I did here, computer science. And I was just mentoring several people, and one of them said, I want to set up a business and I need a bit of capital. So I wrote a small check, and it really wasn't very much money, under £2,000, to this business. And we sold it within 2.5 years for 17 times my money. Now, 17 times £2,000 is not a massive amount of money. It's a decent amount of money. And it was during that process, I found out what Angel was. And then so I joined the Cambridge Angels, which is a group of 21 years old, 60 investors, and I've been chair of that for 3 years, so I know the group very well. I learned a lot from the group, and I've given a lot back. And so I sort of stumbled into it and became an investor at that point. And I then developed a huge attraction to doing this rather than running my own business. And the reason I liken this to being a grandparent, though I'm not a grandparent. If you're a grandparent, and you're not, you don't look old enough and possibly haven't got children, grandparent, parent, child. The child is the business. These are the founders, and I'm up here as the investor. So I get involved with the grandchildren, but I can give the grandchildren back to the parents while I go and look at another set of, I'm a grandparent somewhere else. So I don't have to worry about them day to day. So obviously I'd still worry when I get involved, but I can relax in between. So the stress is considerably less than being an entrepreneur.
It does. So let me ask you, which are the critical points that trigger your decision to invest? It's very important. Would be lovely to be known by all the founders.
Yes, that it's not, I've heard it described as when you see an entrepreneur's pitch, you really fall in love with it. And then disillusionment sets in gradually as you read the plan, you look at the competition, you get to know the entrepreneurs have a sort of slight problem with each other, etc., etc. And you only invest if disillusionment stays above zero. I didn't make that up, somebody else made that up. So basically what you're saying is you meet them, they pitch face to face or whatever, and you do the due diligence. At what point you make the final decision. And this is when the enough due diligence has been done that you're happy to invest. Bearing in mind, and I say this to any angel, and I will say it tomorrow morning, once you've written the check, assume it's gone forever. So even if some of it comes back, 30%, be pleased, because in most cases you won't get any back at all. So it's completely gone. So you've made the decision to invest. And this is just a matter of gathering enough due diligence on the team, maybe on the plan, on the tech, etc., to the point where you're comfortable to write a check to the entrepreneurs. So there's no critical point. You collect data, which is some of which is objective, like competition, possibly freedom to operate for a patent, and some of it's super subjective, which is, do I really believe in that person? There's a lot of gut involved in this, and then you get to the point where you say, yes, I will do, and then you commit or pledge, and then one hopes once you've pledged, you will actually write the check when you're asked to by the lawyers.
You say you invest in technology, and let me ask you, what about IP? How is it important?
So IP, because I invest, and I'm quite well known for investing in university spin-outs, I've done 17 spin-outs. I was in Paris actually talking on a panel at the European Research Council 2 weeks ago about exactly this. So in a university spin-out, generally the intellectual property is beginning to be protected. My view about this is that freedom to operate is more important than a patent. So a patent is an expensive thing to generate. There's manpower, there's prosecuting it. It's probably 50 or 60 or 80K to do it, and there's an ongoing cost. the value of a patent on exit really depends on who acquires you. And for some companies, it will be quite valuable and some will forget altogether. However, if you haven't got freedom to operate with the intellectual property, we're talking about stuff that is patentable now. We'll talk about know-how in a minute. If you haven't got freedom to operate in what you're doing, you're stuck, because the chances are that the patent's owned by a much bigger company than you. And the last thing you want to do is to get into a legal battle. There's a saying in the industry that between larger companies, each company is going to spend a minimum of £5 million defending a patent.
Yeah.
And no startup at the stage we're talking about could even dream of having £5 million. So that's when there's a patent involved. But not all stuff needs to be patented or can be patented. Know-how is really important. And know-how sits in, machine settings on, if you've got hardware, it sits in software, it sits in people's heads. So that is important, but that is not protected. If one of your senior software engineers goes off to work for a competitor, you've lost whatever was in his or her head.
I mean, there are startups that receive external funding and are much more likely to fail than the one who find early product market fit. Now, my question is, to what extent funders should actually looking for venture funding and not be focused on try to get some traction by themselves without asking money from outside?
Exactly. If you take the 8 million companies in the UK, these are limited companies and small businesses, very few of those have had external funding, 200,000 or 300,000 perhaps. 5.5 million, I don't know if your business has, your business possibly doesn't do. You might not have had external funding. So your typical, neither of my two businesses have had external funding. So the majority by far of businesses have grown without external funding. Now, this means they've probably had a little bit of capital from the founder or sweat equity, and then they found product market fit early on, which of course applies to service businesses. The thing about businesses like the ones I invest in, they can't immediately get product market fit. And an extreme example of this is a drug discovery company. You cannot start, from day one and have sales, because you've got to find the molecule, you've got to get the molecule tested through various clinical trials, you need to market it. It could be 10 years before, if it's going to a human being, before it goes into human, the National Health Service or somebody pays for it. That, of course, needs funding by some grants at the beginning, but mainly equity. If you take a typical tech business, obviously it doesn't need so long, but it still will need to develop the tech further to take it from an MVP to a product. And then it will need to develop the market. So this is setting up sales channels and actually doing sales. So that's the bit that needs the equity funding. So if you've got a business that can manage without equity funding, it's because you can get product market fit quite quickly. And most, if not all of those, are service businesses. Angels like me don't invest in service businesses because they scale using people, not using tech. So it's not the number of AWS instances that are spun up, it's the number of people you can hire. We know how difficult, and it's got much worse after COVID, and the salaries have gone much higher. It's so difficult to hire people, so that limits the rate of growth. So people like me, tech investors, will only invest in technology businesses. So come back to the statement, and I suppose what's happening here, take it further, is if you're building a business and you're relying on investors and you overpromise, underdeliver too many times, you won't be able to find new investors. If you can't find new investors and you haven't got to break even, how are you going to pay the salaries next month or the month after? And then you've either got to shrink the business rapidly down to break even, or sell it. But we all know that selling a business as a fire sale or urgently, you've got a business on exit should be bought, not sold. I don't know if you've ever heard that. It needs to be bought by somebody because they want it, not sold. And if you're in a hurry to sell something, you really won't make any money at all. Or of the three options, shrink to break even, sell, or the other one's failure. And that's what happens. And these are failing because they can't raise further funding, because the investors have lost interest and they can't find new investors. So I'll stop in a moment. So it means that if you don't take investment, you don't get onto that escalator, which will probably lead to failure if you don't deliver correctly.
But thank you, Peter. But what do you think? I mean, my thinking is tech company today has been me thinking that getting money is too easy, right? So the business model is made by let me sell as much as I can. I don't want to take care at all about profit and margin and EBITDA. But this brings a company like WeWork, which everyone knows, going to IPO, making billions of loss. How come this can be sustainable?
Well, it can't, because in the end, on the stock market, people want to see EBITDA and they want to see multiples of that. But they do invest. You can take a drug discovery company that hasn't got to market and you can IPO it. In the good times, you probably can't in the bad times. And WeWork got on there because of the rapid growth they had and the story they had of when they would get to, although of course they didn't IPO in the end. That was just, it all fell through in the end. It's the story. So in the end, IPOing is based on a story, but in the longer term, it's almost certainly based on EBITDA, on making a profit and then a multiple of that profit. So yeah, there are many companies that are raising finance, partly because of our generous tax breaks, partly because of where else do you put your money at the moment? You can't put it in the bank, you can't put it in property. And so there's a lot of capital gone in into our sector, but it's the ongoing supply of that capital, if needed, as they grow, that's the problem. So the very early stages, lots of money. I'm on a panel actually in Alexandria in Egypt on Tuesday, although not there, I'm on Zoom, discussing this, the availability of capital, and is it turning down? Is the amount of capital coming down? Is there going to be a turn in the market where valuations are coming down?
I do believe so.
I strongly believe so.
I do believe so. I mean, talk about market. Where do you think is going to be most of the money invested? 2022, 2023?
That's a really good question. And I'm in a sort of slight bit of a bubble here in what I see in Cambridge, because I see a lot of tech. I see stuff that's coming to market, coming for funding out of laboratories, which doesn't necessarily even know what the market's going to be as they develop it. But if you look at the wider picture, there's a lot gone into fintech. By that, I mean consumer-facing fintech in London. It's not something I do, but there's still a lot of opportunity there. Crypto, and I have no time for it all. That's just my view. But there is definitely will be a use or many uses for blockchain in due course. I still haven't seen one I like the look of, but there's definitely something there. Something I'm particularly keen on is personalized medicine. So medicines are very generic, but they're gradually getting more focusing on disease types, and then they'll focus more and more on an individual, because we're all different in our own ways. So these personalized medicines, whether they're protocols or they get to the point where you can have a custom molecule designed for you, that's a difficult sector to be in, of course, because that's a long time to market. There's a whole stack of things around IoTs past the hype curve, but there's a number of, it's on the way down is Internet of Things, but there's a number of verticals where that works really well. So my crystal ball is no better than yours, Max, but I can see, what I do see, which I'm sure you do as well, you see business plans which show what the future is going to look like to some extent, because some of the stuff that's you see, and most won't succeed, we know that, but some of them will actually be what in my case, my kids will be doing in 20 years' time.
I agree. Anyway, business plans are always beautiful on the paper. They are. We've been covering very nice topics, and I would like to close with what can be a tip to give to founders, especially the beginners, the one who wants to start a business but had no idea actually how to do so?
Well, yeah, if you're going to raise funding, what you need to do is build up a network of founders that already raised funding. You'll learn a huge amount from them. You'll learn more probably than reading my book. And then if you're going to go out to for funding, external funding, please do research on the potential funders. Just, you know, there is usually, if you're going through an angel group at an early stage or a platform or something, through a crowdfunding platform, you can't do any research. You can only do research on whether Seeders or Crowdcube's the better one to go through, or whatever the other small ones are. But if you're going out to angels who write checks of, say, 10 or 20K, do some research on them, approach them, do them in the same way you would do when you're trying to find customers. You know, early stage, because in the end, we are customers. It's just that we give the money to you, which in fact the customer does, doesn't it? If you're a supplier, the transaction's the same. You give me a share certificate and I give you a check for it. It's no different from a customer. So do the research on that, work through a funnel, then approach the ones you think will be most valuable to you. So there's a combination of learning about the funding process from other people who've been through it, and then doing the research before you go out and actually knock on people's doors. And then there's a whole stack of other things once you've got the funding and starting building the business. But I'm afraid you're going to have to read both books then, aren't you?
Please give the title of the book, because it's beautiful. I don't remember now, but it's the
Investor is the first one, and this is the one. As you can see, it says 100 entrepreneurs, investors talking to the reader, basically. So,
I got both.
This is not a plug for the books, please. Can we understand this? Max asked me to come on this.
No, because I've been reading both of them and they are beautiful. So if they can, they should, absolutely. I will advise them to do so, because they're very well and easily written, so everyone can understand, which is great.
Thank you,
Peter. Thank you very much for coming to VC Talk. It's been a very great pleasure. I'm humbled to have you.
Yeah, I really enjoyed it, Max. You've interviewed very, very well. Great conversation. Thank you.
Thank you very much. Take care.
Thank you.
Bye-bye.